Entrepreneur relief for people that own their own limited company. Again, I'll go back to the same standard profile of the £100,000 annual revenue for a company and just extrapolate that over a number of years to explain how this works. So probably the easiest way to start this is by saying, if we have the £100,000 we're billing for year one, you'll gradually bring that revenue in, but over the course of time, as we've already discussed, you'll spend some on salary, some on expenses, some on dividends. So you won't have all of the money left at the end of the year, unless you haven't used any funds at all. But let's assume sensibly you have spent some of the money. Let's assume, in my example here, you have hit the higher rate tax threshold of £50,000. So as we get to the end of year one, you have a pot in your business of £50,000. Now let's assume you don't need that, you don't want to suffer tax, you want to leave it in the company and wait to draw it at a later date. But let's assume you do this year on year on year. So let's just keep going all the way across, and let's maybe get to year 5 and say we've done this repetitively over 5 years, nothing's really changed, you've just carried on the same strategy, but at this point you now have £250,000 sat in your business bank account. Now the options are here, you could just say, well, I'll carry on doing what I've always done. I'll draw my salary, dividends and expenses, and I'll deplete that money over the course of time. There's an argument for that, because you could find that if you're not drawing any other income, you can utilise your allowances as per our first presentation to really try and draw as much out of the company as tax efficiently as you can. However, not many people do that. You tend to find that you'll move on to another job, take another role, move overseas, or do something different. So let's assume you're in that position where you want to consider entrepreneur relief. Now, entrepreneur relief is a capital distribution, a capital gain, not an income distribution. So the tax implications are very different. So again, we've covered all the tax side here, so we won't go over that. Let's now say we want to draw this money out. Now, the only way you can draw this out using entrepreneur relief is to close the company down using something called a members voluntary liquidation, an MVL, which again we'll explain later. Taking this £250,000, let's assume that's after corporate taxes, because it has to be after corporation tax. You've got £250,000. You're now going to draw that money out using a members voluntary liquidation. You have two things to consider. You have your capital gains tax allowance, which is currently £12,500. You pay no tax on that at all, so that's zero. You're now left with £237,500. This, if drawn as salary, would probably lose half of it or more in tax. Dividends, probably about 40%. Or we have to think of other ways to distribute that money, which we can talk about in the expenses meeting. But let's assume you distribute this, again using entrepreneur relief. That suffers 10% tax. So you would be able to draw from your £250,000 around about £212,000 net of all taxes, which is amazing. You walk away clean, you've got no further liability. This tax that you are due here, which is broadly speaking the £37,500, that is reportable in your personal tax return in the year after you've had that distribution. So if you found that you were drawing the money anywhere between the 4th of April 22 to 23, if it's drawn here, then your tax is not due until January 24. So you've got a huge amount of time to sit on the money, park it in a premium bond or something else with it, and then pay that within your tax return. But in essence, that's entrepreneur relief.